So the insurance industry actually created its own nightmare here because all these companies saw an opportunity to go away from whole life where all the risk is on the insurance company to get into IUL where they shift the risk to the insured. Now what's happening now is you have these carriers that are going out and creating their own proprietary indexes, and which is, by the way, the scariest thing of all time. If this was such a good strategy, they would take every dollar that they had that they knew they were going to get from a return in their active money in their general fund, and they would take their own money and they would buy the index because they wouldn't have the admin fees, the charges, the insurance costs, all that stuff. And if they're telling you you could get 6.5% or 6.4% like Curtis Ray says and Doug Andrews says, then they would be getting 7.5% or 8% because they have no fees that go with it, right? Like, think about that. Just think about it. Like, common sense goes a long ways in this scenario. Hey, what's going on, cash flow hackers? It's Chris with Life 180, and for this video, I wanted to do a video actually in response to a comment that I had on one of my videos talking about, is Index Universal Life a good fit for infinite banking? And the reason I wanted to respond to this, because A, it's a comment I get quite often. I think people are asking a lot of questions around this, but ultimately what it comes down to is, and what I'm gonna do is I'm gonna share this. I'm just gonna share this comment. I went back and forth with the guy. He's a nice guy, nothing bad to say about him. It's an honest, great question. But I wanted to make sure I took the time to respond to it and to give some feedback. And it's one of those things that's really hard to put into words. So it's this comment right here. So you're telling me, I'm gonna just read it. You're telling me that a cap rate for a company is 9 or 10% and the stock market goes 15% or more like it has been doing in some years, they still have to lower the cap rates? It doesn't really make a lot of sense to me because the insurance company still makes a lot of money on the cap rate, considering we've all been in a bull market. I don't see solid companies going to 5% on a cap rate, I'm assuming. Also, if you compare a company like Allianz, 10-year performance to your favorite whole life looks inferior, and I don't see it looking better the next 10 either. All right, so here's just gonna be my response to this. So it's important to understand how insurance companies create the cap rates, right? It's not just a matter, a lot of people think that the insurance company is making the spread. So for instance, if the cap rate is, let's say it's 10%, right? They think that if the market does 15% on a year, that the spread here equals profit for the insurance company, right? Nothing could be further from the truth. That is not how it works. What they do, here's how the cap rates are created, and this is really important to understand. Cap rates are created by going through and the insurance company says, okay, how much money do you have in your policy? Let's just call it $10,000 for the sake of argument, right? So if you have $10,000, what happens is the insurance company looks at you and they say, well, we know, I'm just going to divide this up. We know that you have, our general fund is creating 4.5% return, right? So what we do is we know that when you give us your $10,000 deposit, we know that that's going to create a $450 profit center. So this is what happens, and this is why cap rates are getting reduced even in a bull market when the market's doing this 15%, and why the insurance company isn't making money and profiting, and why they're having to drop cap rates is because what they do is they say, well, we know you have this $10,000, and so what we're going to do is we're going to say we know that 10,000 is going to give us 4.5% because that's what our general fund is producing. And so we're going to take that return that we're getting in the general fund and we're going to take this $450 and we're going to buy options with it. Okay. And with the options that we buy, that's how we could say we're going to buy a call option, right? And so that's how they give the upside potential and the downside protection, because worst case scenario or best case scenario, they buy these options and whatever the gain is of the options, you get credited with, right? You participate in the market. That's why you're not buying the index, you are participating in the index, because your policy is not really getting the funds or the shares of the index. You are just participating because they're taking the money that they know, they're crediting that to your account. Now what happens is they know that if they have a 10% cap rate, right, this $450 has the potential to create $1,000, right? Right, because 10% of 10,000 is 1,000, okay? And so that's what they know they can do. Now, the worst case, how they give the downside protection is the worst case is they know that this $450 is going to be lost, and therefore your principal is protected, right? So you could earn up to the 10% with a 10% cap rate, and that's how they do it. They're not earning any spread. They're not doing this. Now, it's important to understand the point of this video is why are cap rates being reduced? Well, here's the deal. If you go back, just do some research, and I'm going to erase this. If you do some research and you go back to 2011 and you look at the amount of carriers that were actually in the IUL space, that were actually participating in the index universal life space, it was a fraction of what they are today, right? So when you look at the indexes that are legitimate and viable for index universal life that the carriers are using, they're using the Dow Jones, they're using the S&P 500, they're using the Russell 2000, they're using these big indexes. And that's ultimately when IULs first started, when they were a little better. They were using these good kind of benchmark indexes that were, kind of blue chippy, I'll say. They're more solid, big history, so on and so forth. But the problem is the amount of insurance carriers that were selling index universal life went up, right? And so what did that do? That means the S&P 500, we're just going to focus on the S&P 500, index pressure went up, right? And when I say pressure, I mean the options on it, because the more supply and demand, the people that you have buying options in an index, the cost of the options go up. That's just the way it is. So the insurance industry actually created its own nightmare here because all these companies saw an opportunity to go away from whole life, where all the risk is on the insurance company, to get into IUL, where they shift the risk to the insured. And in doing so, they look at this and they go, they're buying these indexes. And what happens is a more competitive environment, the supply and demand goes down, the cost of insurance goes up. And so look at this. Let's go back to these numbers here, right? If you have this $10,000, right? Right now, $450, we know that's what they can buy in options, right? And that's how the cap rate is created. But here's the bottom line. What winds up happening, I should say, is that over the past decade, the cost of options has gone up drastically. Just do some research on it. It's easy to find, right? And so what's happening is this $450 just doesn't buy as many call options. So therefore, while the cap rate used to be 14% when I was selling IUL, 14.5%, actually 16% on a couple companies. But while one of the main carriers that I was working with used to have a cap rate of 14.5%, it was because the options were cheaper. That's it. The cap rates in an index has nothing to do with the performance of the index and everything to do with the cost of the options to buy in that index. Now, what's happening now is you have these carriers that are going out and creating their own proprietary indexes, and which is, by the way, the scariest thing of all time, because what happens is they get to like have a look back and say, oh, well, we're gonna just create an index and we're gonna just pick this basket of funds, of stocks, and we're gonna figure out what that cap rate would be. And so what they do is they say, okay, we're gonna pick 100 different stocks, and over the last 30 years, that 100 different stocks performed at an average of 9%, let's say, just hypothetically speaking, or 10%, or something of that nature. And so what they say, let's just use 10% for the number. So what they do is they say, well, we know with this look back period, this is what this basket, what this index would perform at, right? But the challenge is they're able to like pick and choose and select, and past performance is not indicative of future success or results, right? Like that's on every disclaimer of every investment out there of all time. And so they like cherry pick these things to make their index look good, and that has no indication of what that will be moving forward. And you have to know that the only reason they created that index is because of the problem that they created for themselves right here when it comes to creating the supply and demand issue with the S&P 500 index, with the Dow Jones index. And so that is what's causing the issues. That is why the cap rates are going down, the participation rates are going down, and why any mechanism, it's important to understand that index universal life policies will always have a function in them, a lever, a mechanism, something in them that shifts the risk of the policy from the insurance company to you. All you agents out there that are gonna call me and say, well, we don't have a cap rate, we don't have a participation rate. I promise you, actuarially speaking, it is impossible for the IUL long-term to outperform the performance of the general fund of the life insurance company because of the way that they buy their call options, because of the fact that they're taking money from the general fund that you put in there and they're buying the call options with them. If you could outperform it, if this strategy worked, think about it this way. They go, we know we're going to get 4.5%. If this was such a good strategy, they would take every dollar that they had that they knew they were going to get from a return in their active money in their general fund, and they would take their own money and they would buy the index because they wouldn't have the admin fees, the charges, the insurance costs, all that stuff. And if they're telling you you could get 6.5 or 6.4% like Curtis Ray says and Doug Andrews says, then they would be getting 7.5 or 8% because they have no fees that go with it, right? Like, think about that. Just think about it. Like, common sense goes a long ways in this scenario. And so when you look at this and you realize that it has nothing to do with spread, it has everything to do with the fact that they're taking your money, they know they're getting a fixed return, they're buying call options with it, the cost of the call options is going through the roof, that's why the cap rate has to come down. And if you realize that if this made sense, they would be doing it to increase the performance of their own general fund. This is why I'm saying the risk gets shifted from the insurance company to the insured, and that is why long-term, I don't care. I understand how good IULs look when they're being illustrated. I understand what they look like on paper, but fundamentally, foundationally speaking, they can never, ever compete. They just won't. It is the ultimate trust me product, and I don't know about you, but I'm not gonna trust the company when they have to hit their numbers and keep their profitability. They're gonna tap into your potential earning power. That's just the way it is. I've seen it. It's happened. The history is there. The history in the last decade of insurance companies dropping cap rates the way that they have shows that they're going to do what they have to do. It's not about you. And the guarantees are horrible. And honestly, it just is what it is. And it drives me nuts when people use the fact that these companies that have shifted to IULs that used to be whole life carriers or still have whole life, but they offer both. It drives me crazy that people are out there talking about the insurance companies, the mutual companies, or the fact that the industry as a whole has companies that have been financially stable for 170 plus years, but this product is basically still in its infancy when you really think about it. And it's younger than almost everybody watching this video is my guess. And the bottom line is, if you look at the results of said product and it's still in its infancy, it's pretty abysmal. And if you look at the patterns of what they do when they need to reduce cap rates and when they need to increase charges and when they need to do all these things, they're gonna do it. And when you understand why they have to do it, it just makes sense. And so that's it. So anyway, I hope you found value in this video. I think what I find is most agents I talk to don't understand this. They don't understand this functionality. They don't understand how the indexing works as a whole. And so hopefully this gave you clarity. If it did, please smash that like button. If you haven't already, hit the subscribe button, click the bell. That way you get notified every single time I launch a new video. And have a blessed, inspirational day. And we'll see you on the next video. Take care.